In today's episode of Crypto Over Coffee, we are talking about arguably the most important thing that you can possibly do in crypto, and that is forming a crypto strategy. Now see, it's not that difficult in a bull market, in a full bull market, to make profit. What is really hard is keeping it. Keeping your profits and not riding your coin all the way up to all-time highs and beyond, and then all the way back down and even losing money on the other end. So in this video, I'm going to walk you through my strategies from walking through and working through 3 full bull market cycles, including the 2017, 2018 cycle, and then this last 2021, 2022 cycle. And in fact, it is so much harder now than it even was back in prior bull markets because there are so many different narratives, so many technical things you have to get to know, so many things you could research. It's so distracting. And the sophistication of scams and being able to verify what's legit and what's not is very, very difficult. So I'm going to walk you through how you can do the maximum amount of work up front to protect yourself from scams, to protect yourself from making common logical fallacy mistakes as you approach the crypto markets. So let's go ahead and dive into it. And if you like these type of videos, please let me know in the comment section. Shoot me a post on X at Hashoshi4 and subscribe to the YouTube channel. All of the above are much appreciated. So let's start. First things first, when you're making a plan, that obviously starts with creating a thesis for what you believe you should be investing in. And I think one of the things that it started to really become clear in 2021, when we really had that absolutely insane quantitative easing driven, free money driven bull market, is that it is almost impossible now for anyone who doesn't spend their entire life in crypto, meaning if you have a regular job, if you have a 9-to-5, if you got kids, if you have a spouse, if you got friends, if you got a life outside of crypto, it is virtually impossible to spend the amount of time that you need to spend researching and staying close to crypto Twitter and running through the depths of Reddit and Discord and finding all the right projects and learning all the stuff you need to learn and keeping track of all the different niches that there are across gaming and SocialFi, friend tech, and DeFi and NFTs and art and SocialFi, all that stuff. You cannot keep track of everything. And so my advice to you would be to pick no more than 3 major narratives that you want to focus on in this bull market and just devote yourself to finding the existing players, the existing established projects that you think are going to thrive, and use those as your jump off point, not only to understand why you think they're going to do well from a dollars perspective, from a token perspective, but also the technology that makes them good, the tokenomic structure that makes them good, and use that as a jump off point to find other projects that fit that sort of mold. Think about where you think the users are going to go, the liquidity is going to go, and the problem, the fundamentals part, is the most important. What problem is the project trying to solve? Is it a sufficiently difficult problem? Is it a sufficiently pervasive problem? Are people actually struggling with this? And what is the value of solving it? Lastly, how is the project going to solve it? And does that make sense? And the last part of the fundamentals analysis is, even if the project is successful in solving the technology problem or whatever problem they're trying to solve, does the token directly benefit from that solution? And that is a big one, because not every token is designed in a way that attributes or that encourages value appreciation when it's adopted and when it's used. Not every time. Sometimes it's strictly a utility. And so you'll need to think about all of those things as you formulate the plan for what you're going to invest in. Now, in a bull market, this job is a little bit easier than it is in other phases of the market because what you're looking at is a space that is growing rapidly. You're looking at funds and liquidity flowing into the market at large, rolling out of Bitcoin and into layer one ecosystems, and then from there into projects in those layer one ecosystems and into the layer twos that support them. And when there's a lot of new capital flowing in, it's very likely that at least a good number of the projects that you pick, if the narratives that you chose actually thrive and do well, will also do pretty well. Now, picking 100x's, 10x's, etc., that's not what we're talking about here. I can't prognosticate whether the projects you pick are going to land there. But what I can say is, generally speaking, in bull markets, if you pick the right narratives and you do a little bit of due diligence and look at fundamentals analysis, you will pick at least some winners. In a bull market, what you often have is you have basically three categories of projects. You've got legit projects that do really well and that stick around even when the bear market comes. Those are very rare and they are difficult to find. You have projects that are bull market picks. They do really well. They are really good at marketing. They're really good at generating buzz. They may have some lucrative partnerships or good influencer partnerships in the space. And I'm not talking about just the YouTube ones, but technical thought leaders as well. Or exchanges as well, right? That's another big one. And then you have a third type, which is the flash in the pan, quick 10x, 100x type of coin that comes in, makes a bunch of promises it can never deliver. It generates a lot of interest. It rolls way up. And then all the people who come in trying to chase that pump, chase the FOMO, their exit liquidity. Now, the point of this video is to make sure that you don't fall into the traps from those latter two types, which is the bull market growth and then fall off the face of the earth projects that when the bear market comes, they're gone, as well as the flash in the pan where in the matter of 1, 2, 3, 4 weeks, a project rolls up 100x and then tanks and basically goes to zero. The first category, the really established multi-cycle types of coins, you hope that you'll pick up those coins in the process, but I'm not really focused on those here. Though the strategy I employ for the middle one, which is the bull market pick, also applies to those multi-cycle, dime, like 10 out of 10 projects. Okay. So let's talk about now how to keep your profits. How do I plan ahead when I'm building out my investment thesis and my strategy, my plan for crypto? The very first thing I do is I used to use software for this, but I've now realized that it's actually just as easy to just use a notepad for it. Not necessarily talking a physical notepad, but go into your favorite note-taking app or an Excel spreadsheet. Gasp. I guess it shows how old I am that I would even suggest that. Go in there and list the coins that you're targeting. Write in some of the fundamentals analysis, like why are you investing in it? What was your entry? And if you haven't bought it yet, but you're planning to, put in a target price or a target date or a notable event that's coming that you think is going to drive the price. So make a plan for when you're going to enter. For cryptocurrencies that you already have in your portfolio, when you buy them, you should be establishing right up front at least 3 benchmarks. And these are benchmarks where you are going to sell. No matter what happens, rain or shine, bull or bear, you are going to sell at these levels. So let's say, to make this example really easy, and I'm not going to name a specific coin because I know people are going to go buy it if I mention one. I don't want you to do that. Let's say I found an altcoin for 10 cents per your token in the DePIN, decentralized physical infrastructure space. And I want to buy that coin, and doesn't matter how much I put in. Doesn't matter how much actual money I put into it. It's 10 cents per token. What I would do is I would go into my portfolio note or sheet or whatever I'm using, and I will write in at 12.5 cents, so a 25% gain at 12.5 cents per token. If we get to that point, I'm going to take X amount. Usually I would say if it goes up by 25%, in this case, that's what it is, it hits 12.5 cents per coin. What I would do is I would take a quarter of my principal out, right? So that's a quarter of what I put in, I take out. So now I've already insulated myself from some downside. Then I may say, if I get to a 2x or a 5x, and really this is where you have to do a little bit of judgment call, right? Do you think that this coin is one of those super high risk, like you look at it and you're like, the fundamentals are kind of there, but something looks sketchy about it? Or, the founders are anonymous and that makes, or I found that there's just something weird about this on the website. Maybe you say, I'm going to be a bit more conservative and I'm not going to get greedy. If it does a 2.5, 3x, I'm going to take my principal off the table, and then whatever's left over, it's house money, no problem, right? That's what you might do for that second benchmark. So between a 2.5 to a 5x, and everyone was probably going to be like, oh, dude, that's ridiculous. What if it 100x's after that? What if it 100x's? It's this micro cap altcoin. It 100x's. By the time a coin 100x's, oftentimes you get to the point where liquidity is so thin, depending on the chain you're on, you might pay incredibly high fees to just get out of that coin. But even if fees are not a non-issue, you're trying to sell into thin liquidity where you're very unlikely to be able to capitalize on that gain. It happens all the time in these micro cap, especially in the meme coins and some of the super micro low cap coins. Your paper gains are unrealizable because you can't actually sell them for what you think. So by selling early and taking the wins that you got, you may be leaving paper gains or even realized gains on the table, but at least you get to keep yours. I rest my case for a second. We're going to get back to that. The third benchmark is sort of your best case, right? It's if I see the coin is running up, and I've already hit my first two benchmarks, I've already gotten some profit, I'm not going to hold a moon bag forever. If I see that this coin 50x's, I'm taking the rest off the table. Because now you have accomplished a few things. Number one, first of all, you ensure that you don't lose everything, right? In most cases. Of course, there are going to be some times where you enter and you enter at the wrong time. The coin tanks, you lose it all. That's why the first phase is trying to pick the right projects. You're going to lose some. This planning is not going to prevent you from losing. It's going to prevent you from losing everything in some cases, right? This is more about round tripping and avoiding that. So that's what I do. I go in and I write down 3 benchmarks where I'm going to sell. That way, pretty much no matter what happens, if I've made a really decent pick and this coin is something that ends up rendering me paper gains, I'm not leaving those paper gains on the table, because I know that in the moment, either I'm not going to pay close enough attention to red flags that come up and I might miss an opportunity to sell, or I might just get greedy, because humans are just naturally going to say, you know what? I want to see what I want to see. It's confirmation bias. You're like, should I sell this altcoin? It's gonna 5x. I've made a good bit of money. Should I sell it? You're like, oh, I think it's gonna go higher. Then you go on X and you look at all the posts and everyone's like, oh, it's just getting started. Here's this partnership, which isn't actually a partnership. It's just like they used a cloud provider and now they say it's a partner. You go there and you're looking for things to confirm your desire for it to go higher. And then you're like, you know what? Yeah, it's going to go higher. I'm not going to sell. And then it may go a little higher and then it tanks and you have lost all your paper gains and you're left with nothing. Happens all the time. And if you ask anyone, including people who you're like, oh, they're tens of millions of dollars in their crypto portfolio, the best traders that they will all tell you the exact same thing. They've done that many, many times. We've all done it. I've done it. You've probably done it. This is the reason why I'm making this video, because I've learned this lesson the hard way. And I put in systems to circumvent my human nature on this. So that's the first thing that I do whenever I enter into a new crypto project. And going back to this note thing, why I don't use software for this and why I track my portfolio manually is because it prevents me from spreading myself too thin. because I don't want to have to deal with tracking like 400 cryptocurrencies in this spreadsheet or in my note. It makes me think more deeply about what I'm putting in the portfolio, what I'm going to track, and what I'm going to do the work to plan for. So instead of spreading myself too thin, knowing I will not be able to keep track of all of these micro cap coins that I'm trying to buy or low cap coins, etc., is that I know that by keeping track of these individually, it's going to be a check and balance for me. I'm going to keep my portfolio at any given time no more than, I would say on average, like 40, 50 coins. And there's a reason for that, because if you're taking profits during a bull market on the right cadence, you're not going to have too many more than 50 coins in your portfolio at any given time. Maybe that's your thing, but I don't personally, because I know I can then keep a close eye on each of those and give them the due diligence that they need up front and during, and I can watch the prices and all that sort of thing. This space gets very noisy during bull markets, and so the less you have to keep track of, the less you can get distracted by, the better. And it's better decisions that you're going to make. Also, it doesn't mean you can't get exposure to a bunch of different coins throughout a bull market. It just means at any given time, you only have a certain number in your portfolio. That's my personal preference. I'm not going to impose that one on you, but that's the way that I do it because that's how I work. The other thing I want to mention is the mix. Okay, this is very important because the mix of cryptocurrencies by market cap that you have directly reflects the risk that you have in your portfolio. And if you ask a talented trader, which I am not, and that's the reason that I work like this, I'm a fundamentals guy. I'm not a trader. I'm a tech guy. I'm not a trader. But I've learned how to, without day trading, do as well as possible in bull markets, which is what I'm sharing today. If you ask any really experienced trader, they'll tell you that the primary task is not necessarily picking the best possible trade. It is risk management. It's cash management. It's preventing yourself from getting completely bounced out of the market and blowing your fund. That is the key. So it is as much about risk control as it is about picking profitable trades. So with that in mind, another mistake I see people make all the time is they keep gunning for that 100x. So they're looking for the most obscure microcap coin that they can possibly find, and they're just like yeeting money into 50 to 100 of them and hoping for a hit. And occasionally you'll get one if you can sell it when it goes 100x. The problem is when you allocate too much of your portfolio to these microcap, low cap coins, is you are exposing yourself to an excessive amount of risk because there is far more risk in those coins than there are in established projects. So this is the way that I set up my portfolios. Is I generally will set up my portfolio to have at least 40% exposure to what I believe to be, and sometimes you're wrong on these, right? But what I believe to be cycle to cycle, sort of cross cycle established coins, right? So some of the L1 chains or L2s that support your given narrative. So if I'm interested in, let's just give an example. If I think DeFi is one of the big ones, right? It's one of the things, I might have exposure to a handful of different L1s and L2s in the Ethereum space and Solana and Avalanche and a few others, right? Great. No problem. That's going to be a big portion. And yes, people are going to say, excuse me, those are not going to go up very much during a bull market. That's debatable. They go up. They're just not going to go 50 to 100x usually. And that's fine. Profit is profit. From there, you can play and you can gamble a little more because you have a decent amount in a relatively safe position. The same rules apply, by the way, though, and I don't want you to forget this. The same rules apply on the benchmarking thing because stablecoins exist for a reason. If I'm an Avalanche is hype, right? And I'm making that play on DeFi. Avalanche is hype. It goes up 5x. You bet your butt I'm selling and I'm moving into stables and I'm shifting Avalanche out of my portfolio. I may buy back in when the hype fades inevitably and we have a major retraction. So I don't want you to think that you just set it and forget it on the L1s. You should be setting benchmarks for every single coin in your portfolio, whether it's an established project or a microcap, all across the board. Just want to make that clear. The other larger allocation you can make is some of those sort of mid-cap projects. Likely these are projects that started in the bear market or that started right at the tail end of the last bull market, but survived. These are generally projects that have some established value. They've continued to build. You've seen now that the project has managed treasury effectively during a poor liquidity period. Celestia, it kind of fits into that. That's an interesting idea or example of this. Solving a real problem, data availability in the space, in the Ethereum space especially. And they survived through, they kind of stuck around, and now you're seeing they're just continuing to grow and grow and grow. I think it's up 875% on the year, right? So that's a great example of one of those types of coins where it's not in the top 10, but it's growing. That should be another, double-digit percentage allocation in your portfolio. And then no more than 15%. I actually usually keep it closer to 10. But between 10 and 15%, that's where you're throwing those, like, yeeting a small amount of money into micro cap, low cap coins. That's where your upside potential is far higher. But, and that's a big but, your downside risk is also huge. The likelihood that you buy one of those low cap, micro cap coins and it does a run up while you're on the toilet, and then by the time you put your kid to bed and you go back to your phone, the coin's already like gone to zero. Those types of coins, or ones where it's like a 2 to 3 week hype cycle and then a rug, that's the type of thing you have with mid to low and micro cap coins that you're not necessarily going to see with established mid caps and the large cap sort of blue chip types of projects. So you can get exposure to a narrative without making your whole portfolio a casino. Crypto in general is a zero-sum game. And so what that basically means for you is that if you don't take profits, you are exit liquidity. It is that simple. And the other thing is, this is going to probably be peak irony of the day, but you should not be taking your advice on when to buy from influencers, okay? Please. The way that this space works is through marketing. There's a lot of marketing in this space. Influencers are the easiest way to market a coin to buyers. When people buy a coin, influencers and the project founders and the insiders and the private sale people, etc., those people obviously have asymmetrically higher probability of success and benefit than the person being told to buy on a video or on a podcast or in an X thread. So my point is that chasing FOMO and chasing hype is usually a one-way ticket to at least mid to long-term failure. In the short term, it may be great, right? If you watch a video, notable influencer, they say, buy this coin, I'm buying this coin, etc. Sometimes they are, sometimes they're not. You buy the coin, it goes up because everyone else watching that video is also buying the coin. But then what happens? A few weeks later, a few months later, something weird starts going on. Big sell walls. Everything starts dropping. And then everyone sees, oh, the coin's dropping. I want out too. You have the psychological selling pyramid that just comes crashing down. I almost knocked over my drink. Anyway, that's a big issue. And that's why I would say, if you have a plan in place when you consume content online, you look at those as opportunities, not calls to action. You look at each video that you watch. When you hear about a coin, you're like, oh, I've never seen that one before. That fits my narrative. That fits the plan that I had. That's in my top 3 narratives for this bull market. Let me go take a look at that coin. You learn about it from that influencer. Thanks, influencer, for telling me about this coin I didn't know existed. Then you go do your research. You say, you know what? That fits into the mid-cap section of my portfolio. I just sold this coin that's in my portfolio, so I've got a little bit on the sidelines in stablecoins. We're going to talk about that in a second, so stick with me. This coin actually makes a lot of sense here, so I am going to buy that. But the difference is you didn't watch the video and then just take that influencer's word for it and buy the coin. You heard about the coin you never heard of. You compared it against your established strategy from the very beginning. You said, you know what? I've got some funds available. I'm not going to dip in to funds that I can't afford to lose. I'm just going to put back in play some funds that I've already made profits on. Great, cool. Now you're in. You've done research, and hopefully you've set your benchmark so that you know if this thing does a 15% gain, then I'm going to take some of my principal out. This is fundamentally the strategy that I would employ. And you know what? I do consume other influencers' content, if you would believe it, because I think it's a good way to just learn and scale yourself. You cannot do all the research. You cannot spend every waking moment of your life in crypto. At least I can. Maybe you can. I'm not telling you what to do. But learning from others is great, but it's your money that you're putting on the line. So you really should be spending the time that you need to form a strategy. That makes a lot of sense. Okay, I mentioned stablecoins a second ago. This is the other thing, and this may be, I don't really understand why, but it may be controversial to some. When you are taking profits, you should also be building in some degree of thought to your tax situation. This is a hated topic because people say, oh, taxes suck. Yes, taxes are terrible. I hate taxes. You hate taxes. Nobody likes taxes. However, they are, despite what people say, not optional. So, given that, if you would like to comply with tax rules, you should be thinking about this throughout the year. Because if you are taking profits throughout the year, like you should be, then you will be accruing capital gains taxes, especially if you are doing that with coins that you've held for under a year, if you're looking at it from the US tax code. So the way that I do this is actually using software. There are a bunch of different softwares out there that do a really good job of this in tracking your portfolio. I think that they're worth it because doing this manually absolutely sucks. So if you do Coin Tracker or Zen Ledger or Coinly or tokentrader.tax, I think it is. There's a bunch of different ones. Regardless of which one that you use, you should have a crypto tax software, which will help you keep track of what you need to be setting aside in stable coins or in fiat currency, if that's what you prefer, in stable coins so that you can actually cover your tax obligations for the year. The reason I say this is because a lot of times people get into trouble where they have a really good run. Say they have 3-4 months in a bull market, really good success. Then they get a little cocky, they get a little greedy, and then they start like just throwing money that they've made in profits and shifting that over to like micro caps and low caps, thinking like I'm retiring early. Then they lose it all. Then what happens is you have a tax bill for all the gains in that first 4 months, and then you have losses that don't fully cover your original gains. So now you are left with a tax bill and nothing to pay it. That is a classic issue that I think people could avoid if they just plan accordingly. It's going to cut into your take-home profits, but something to consider nonetheless. That's the most I'm going to say on the matter. You should be thinking about it and tracking that obligation throughout the year and making choices based off of that. Now, the last thing that I want to point to is the stablecoin situation. There are people from this last cycle who were doing this, and they had this sort of strategy, and they might have been using that UST stablecoin that collapsed with Terra Luna. So when you're talking about stablecoins, you also want to consider, like, is the stablecoin that I'm using something that I'm comfortable just parking my cash in? And then not in every case will you feel that comfortable. The other thing is, where are you storing it? Okay, because what the BlockFi, Celsius, Gemini, FTX situation told us is that those things can collapse. And if they're your custodian, whether it's yield earning or not, if they're your custodian for stable coins that you need to pay your taxes or you need for whatever reason, that's where your profits are, you could lose access to them or lose them altogether if the platform goes down. So if you're not comfortable with that risk, then you may want to move back to fiat, okay? Because at least with a bank in the short term, you can easily get back to those funds, and they are, for better or for worse, insured in many places. Just a thought. So bear that in mind. I actually did get messages from people in this last cycle saying, I put my profits into Celsius Earn, or I put my profits on BlockFi and I lost them all. And maybe they're getting some of it back now, but man, oh man, that really does suck. So definitely be mindful not only of taking profits, but where you're putting them and how you're managing them. Because it's very easy to execute on this strategy perfectly throughout the year. You did all the benchmarking, picking prices to sell, you sold, you did a great job, and then the floor falls out in the bear market, or sorry, the floor falls out of the bull market, and we descend into crypto winter, and suddenly you have basically nothing left, and platform where you stored all your profits is down. Not so great. So just keep that in mind. I think that actually covers the main gist of the plan. The last thing that I want to say, not necessarily just about forming a plan and forming a strategy, it would also be the usage of tools to help you execute on this strategy. I really like data tools. There are ones that are more or less free. Dune Analytics is one where you can also always find some pretty good data, like on-chain data. There are paid ones as well, like Santiment. And I think Glassnode has now some paid features, if I'm not mistaken, and they have some decent data as well. Those can help you make decisions about when to sell, when to buy, what the markets are doing. I think any extra data that you can have is an advantage, as long as you are looking at it without the lens of confirmation bias. Easier said than done. The other thing is, if you are tracking your portfolio, if you're like me and you are not sitting in front of the computer for large periods of the day and you are doing other things where you're focused and you're not looking at the markets, in order for you to catch periods where you might be hitting one of your benchmarks, you should set notifications, if you can, for crypto prices. And there are a bunch of apps that do this. You can pick one of your favorites on the App Store or wherever that will allow you to add your portfolio to an application, and it'll give you notifications of X% gains or price targets, etc. And that, I think, is a useful tool unless you're pretty consistent about checking prices and watching your portfolio. Again, goes back to, that's why I don't have 400 cryptocurrencies in my portfolio, because then I can actually keep track of them. And the final thing on the tooling thing is, it's also really useful to have your wallets and your security posture all set and established before you start doing this. So have cold storage ready to go, have hot wallets set up, and know how you're going to rotate funds there and where each thing is. If you have multiple wallets, people often freak out. They're like, where's my ETH? They forget it's in a different wallet. So make sure all of that stuff is set. Make sure if you use an HD wallet, like a hierarchical deterministic wallet like Ledger, Trezor, etc., that you verified your seed phrase before you dump a bunch of funds on it. Do that once a year at least, if not twice a year, to make sure that you're in good shape. You have the seed phrase, so if you need it, you can use it. And then I would also use something like Wallet Watch, which is an extension that will help you prevent things like approving funds with ERC20 on a drainer, or using some scammy DeFi app, or using a fake front end for Uniswap. Just will make you feel a lot better. So get all of the tooling and infrastructure and security stuff set up ahead of time so that you don't have to worry about that when all you should be worrying about is executing your plan. So that's the last thing I will say. This video is already 30 plus minutes long. Holy moly. But there's a lot of value in here. So hopefully you got a lot of value out of this video. If you did, please, again, hit subscribe, share this video with your friends so that they can also do well in the crypto markets and keep their profits instead of round tripping. With that, I'm going to go crush the rest of this iced coffee. Thank you so much for watching. Thank you for sticking around for the end of the Crypto Over Coffee show. Hope you and your family have a wonderful rest of your weekend. And until next time, cheers.